Oh, we back.
You saw me do my Beyonce head swing.
We back. We back.
Hey!
Did y'all miss us? We missed you.
We did. Wednesdays just haven't been the same.
I know, right? I know.
Yes,
I'm like,
good to
I'm
be
sorry.
here again.
It is. It's so great to be back on. I miss everybody.
I'm
So,
sure somebody had to miss us. I don't know where they at today, but I'm sure somebody did.
right. Somebody missed us. So, you missed us. Say hey below. Send in a message. Tell us you missed us because we missed you. So,
Yep.
all right.
Yep.
All right. All right. So, there's these
Who are we?
three initials that are always brought up. And to the life of me, as a realtor, I'd be like, DTI, debt to that,
Right. What
debt.
is that?
I know it's debt, but
I know it's income.
right, right. But I don't care how many times they be like debt to income, and I'm like, oh, okay, debt. Then I still don't know what it is. So I'm the realtor, and I'm be honest with you. I'll be like, well, talk to the lender.
That's
She
not your
can,
jam. That's not your jam, Dion.
right, right.
Mhm.
Like they come up with these initials and different things, and we you're supposed to know what all this stuff is, and I'm like, I don't know what DTI is.
Right.
DTI. Uh-oh.
But I'm the numbers girl, so I know a little about them numbers.
All
And
right.
your DTI, your debt to income ratio, is basically a number. So we should talk about that today because really anybody that's interested in purchasing the home or even refinancing the home, because you got to calculate it for that too. It's good for you to know. You might be able to calculate it on your own, be a step ahead before you even
Yes.
come and talk to me. Yeah.
Yes. So my name's Dione Branch, and I am with EXP Realty. And we are so happy to have you here on Water Cooler Wednesday. And yeah,
There you
and
go.
I have with me Lisa. Lisa.
Lisa White, the house money mama.
Yes.
Working for Nexa Mortgage, where brokers are better. We the
Yeah.
ones with all the options when y'all trying to figure out, well, how did they get that law done? Because they talked to me. That's how they got
Mhm.
it done.
Right. And so, today we're putting up there. Sorry, guys. The title of today is "What is DTI?" My lender said that my DTI was too high. That my right,
That's
and
usually
then
what
they
people
said
hear. Yeah.
right, and then they go, and then they say, "Okay, and thank you." But we need to understand what the DTI is, and maybe there's a way for us to make sure that we don't come across that or have that issue when we get ready to
Mhm.
purchase a home. So,
Absolutely.
Lisa, what does DTI even stand for? First of
Okay.
all,
That's a good question. That's actually a very good place to start. So DTI stands for debt to income. And when I started in the mortgage business, however many years ago, 14, something like that, the guy actually that taught me, I thought he was a very good teacher. His name was Ron. And he basically just said that it's debt divided by income. You can remember that? It's just like a fraction. you know.
Mhm.
So if you remember that, then that's basically how you figure it out. So for any mortgage transaction, conventional, FHA, USDA, VA, all of those, we're looking at your debt to income ratio. Because really what that is it takes the amount of debt that you have, that you owe, and it takes the amount of income that you generate every month. We do all this stuff for a monthly basis. And we come up with a number. The number is going to have certain, like parameters, if you will. So you can't have it too high because then that means you're spending all your money on housing, and you don't have anything left over. And the reality is, even though we have 100% of our money, we need to have something left over, you know.
Mhm.
So I think one of the reasons why we even have a debt to income ratio is because we want to make sure that we're not burdening somebody where all of their money is just going toward, paying this house and stuff. And they have no kind of, because so here's the thing with the debt to income ratio, we don't include expenses. Probably anybody out there who's an accountant, they can understand that way better than, the regular person would who's not an accountant. But there is a difference between expenses and debt. So debt is something that you pay over a period of time. And usually at some point in time, it can or will stop. When I say can or will, what I mean is, like, for example, revolving debt, like a credit card, it can
Mhm.
stop if you quit spending.
Right.
Because as long as you spending, there's going to be more debt to pay. But now expenses would be something that doesn't really stop, like until you die. For example, as long as you want to have lights, you're gonna need ComEd. so
Right.
so that's an expense.
Never goes
Same
away.
thing. Right, never goes away. Same thing, the gas bill and things like that, utilities, those kind of things. They're considered more like expenses. But like your car note, because that's something that you pay every month, the same amount usually every month until you get to a certain point where you're paid off, that's considered a debt. So we look at
Okay.
your debt to income, but we're not looking at your expenses. So you need to have some money left over because life is still going to have expenses. Life is going to have, we're not taking into account you having money for the birthday parties and, to go places. What we can't really figure that out, because we don't know how people are going to spend that kind of money. So what we do is we just set a standard for, okay, if the person has X amount of percentage of their income spent, then they still have X amount of percentage left over to be able to do other stuff with. So I'll give you an example of a ratio. What one of the parameters is, like for FHA, y'all know I do a lot of FHA loans. That's primarily the kind of financing that I originate. So with FHA, you can go all the way up to a 56.99% on the back end.
Mhm.
So that means all of your debt from your credit report, as well as your housing expense. That's your new mortgage. Um, and anything like, say, for example, child support, tax liens, stuff like that, we include that in as debt also. So you can go up to 56.99% of your debt and still be able to buy a house with FHA. Now, with conventional, it's a little different. You can actually only go up to 50%. So you can only spend about half of your gross income before they consider this being too high. I have hold on. Let's see if I can do this. Share screen. Share screen. Okay, that should allow me to do it. I hope I don't mess this up.
Okay.
Okay, can you see my screen now?
Yeah.
Okay, perfect. So this is basically a simple example of how to calculate your debt to income ratio. Because of course, here on Water Cooler Wednesday with the Allure team and with the House Money Mama, what we want to do is we want to educate you. So you come to us, for the things that you need us for, but there can be a few things that you learn how to do on your own. So this is one of those things that you can do to a certain extent because you're not going to have all the exact same information that I have because of course I do a credit pool as a lender and those are I use to calculate that I calculate income as well that you may not do it the same. So this is a basic formula. Like I said, debt to income ratio is debt divided by income. You do that, you get a number. So let's just take an example. So right here, monthly obligations, we're saying that somebody has $2,000 that they have to pay out every month. And they earn $5,000 in wages. So see here, you have
Right.
2,000 divided by
Mhm.
5,000. I don't know why you put 100 times 100 equals 40%. That's income ratio. So that's
Right.
how
So
you.
they do because it comes out as a decimal, so they times 100 to get the percentage.
Okay, yeah, because I don't do
Mhm.
all that. But anyway, 2,000 divided by 5,000, you know what that is. Point four, that means 40%. So, because
Right.
we already all know that. So, yeah, so that would be a 40% on the debt to income ratio, which actually that's pretty good. Conventional would love that because they don't want you to go
Hmm.
over 50. So you can have that, on conventional with no problem at all. So basically, like if you want to do this yourself, then here it's giving you a way to do that. You have to know what debts to include in your monthly debt obligation. So my suggestion would be if you have a credit report and you can get it free, from Credit Karma, or you can pay for it and get it through My FICO or some of the other places, and that can give you the debts that you would have that I would likely calculate into that formula. And then how much net income. Now, a lot of people ask this question, and it's a valid question. What income do I use before or after taxes? So everything we do is gross. So that means that it's before the taxes. So whatever that first number is that you see as far as what you earn before, IRS and, the state of Illinois and
Right.
FICA and all them people before they,
Everybody come.
yeah, before they start deducting, that's the number that you want to use to calculate your income.
Okay.
Any questions, Dion?
No, I think that helps out a lot. Is there can you share with us again, like, so we know the things that's on our credit report that's included in our debt,
Hmm.
but um, is there anything else besides that? Is
There
it, are
could
we
be.
just
There
okay?
could be. So I did a slight little disclaimer when I was mentioning that initially. So there could be other items that don't show up on your credit, but that we still have to include as debt. For example, um, when I look at a person's check stub, a paycheck stub, like let's just say, for example, that this person has a deduction that comes out on every paycheck stub. Maybe he's paying back a loan to, I
Hmm.
don't know, 401k, or
Right.
maybe it's a child support deduction. So that's something that I would have to include now in his debt to income ratio.
Okay. Okay.
So those
And
kind of things, they may not show up on your credit report, but because it is, basically like an installment loan.
right.
If you draw down from your 401k in the form of a loan, you got to pay it back. So now actually I do have to include it. That's why a lot of times when people, just kind of a nugget here, when people are doing their home purchase and they're asking
Hmm.
about taking money out from their 401k, I'll usually let
Yeah.
them know, hey, listen, all you really have to do is just draw it down as a hardship withdrawal, because then it's not a loan. If you take it out as a loan, I'm going to have to count that against you, as debt, because now you've made another obligation for yourself that you're going to have to pay every month.
Oh, okay.
Does that make
Now, what?
sense?
Yeah. What if a
Okay.
person has a so we say that the mortgage is included if they purchase a condo or a townhome, or they're in a nice area that has an association fee.
HOA.
Hmm.
Yeah. What's HOA? Because we use all these acronyms. So what's
Right.
HOA?
It's
HOA.
homeowners association fee.
Yeah.
So, right, these
Exactly.
three-letter words, right? Three letters that mean something. This wants to know them all. But yes, HOA
Right.
is when you have an association in your building. Condos mostly have associations. You
Yeah.
might have a nice, everybody has a
Community.
nice house, but you might have a home that has an association, so they take care of your yard.
Right.
Take care of the snow and stuff, and they charge you a monthly fee for that.
Correct. Yep.
Hmm.
They do. And so, even though, and sometimes this gets a little bit tricky to people because the HOA fees don't actually, they're not part of your mortgage. We don't collect it. The HOA collects it themselves, but we do include it in your debt to income ratio. So we
Mm,
do like confirm, like I have a contract right now where the person is going to have an HOA. So I have to confirm with the homeowners association, how much the monthly fees are and stuff like that. So that way I include that in her debt to income ratio. So yeah,
yeah,
absolutely. That's another thing that could be included in the debt, even though it's not on credit, but it's still included. And so here's another thing that a lot of people don't know, because usually when people think of debt to income ratio, they only think of the back end ratio. But it's actually two ratios that I have to calculate on any given loan file that I'm doing. The beauty about conventional is that they're the same. Like that 50% that I mentioned, your front end can be 50% and your back end can be 50%. And it's fine. As long as it's not more than 50% on the front or back end, you're okay. FHA, though, is a little bit different. So FHA has the front end ratio is 46.99. That's the maximum that you can have for your front end ratio. But your back end ratio can go all the way up to 56.99. That's the max you can have for that. Now, what's the difference between the two of them? I'm glad you asked. I can
yeah,
explain that. Let's share screen again. Hold on. Because I should have something on there that'll talk about that a little bit and give a calculation for it. Okay. So here we go. We just calculating our debt to income. So now we're going to look at what the differences are. So you don't really have to read all that unless you just really want to. I'll leave it up. But basically, like I mentioned, is two different ratios. So the front end ratio limit your housing expenses. So housing expenses, excuse me, will be your mortgage payment, your so that's like your principal and interest, your real estate or property taxes, your homeowner that would be included in, and then also this would be a place where your HOA, your homeowners association, it would be included in this number. Well as, so here's another acronym for y'all. So we're doing a lot of acronyms.
yeah,
PMI. So PMI, most people have heard of it, but not everybody really understands what it means. PMI is basically, it stands for private mortgage. But PMI, basically, I think of it like an insurance policy. You know how you have your insurance for your car. So you pay, and if something were to happen, now you have the ability to get your car fixed. You still got to pay a deductible, but you can get your car fixed, whatever the parameters are of your policy, right? So that's pretty much how your automobile insurance works. Well, PMI is not that much different. The biggest difference is you're paying the premium, but the insurance is actually for the lender. So what happens is the government put this program FHA together because really what they was trying to do is help people be able to own their own homes. So
right,
FHA is all about, we want to help you get into a house for yourself. Not that you're renting it out to somebody else, but that you actually live there. You've achieved the goal and the dream of home ownership, because there were so many people that got left out of it. That's really why they put the program together, to be able to help more people become home owners. So with FHA, one, it's a couple of things. One, they want to be sure, that you can, the place that you get into is going to be sufficient for you to live in. So they have their own different restrictions and things like that. But with FHA, they also allow more leniencies. They're forgiving. So with FHA, you got some medical collections. They like, that's okay. We'll still do your loan anyway. FHA, you got a charge off on there. They're like, that's okay. Let's do your loan anyway. The point is, FHA will allow. Now, that doesn't mean that everybody's on FHA finance and has bad credit. That's not what I'm saying.
right,
But you are allowed to have some of those, blemishes on your credit, and it's okay with FHA because the goal is to get you into a house. So that
yeah,
being said, think about it if you was the lender. I'm the one loaning the money for the house. FHA just saying they'll guarantee the loan, but I'm the one that's, loaning the money for the house. So I'm like, okay, let's see, you who got, 50 collections. You got you got a charge off, you got a repossession. But FHA say, according to their guidelines, you can still do this loan. I think you might default. So what do we have? PMI. So if you do default, then the same way that with your vehicle, if you got into a car accident, you can kind of be made whole again. That's the same thing for the lender. So you
Yeah.
pay a premium every month in order for the lender to be able to, if something were to happen and you default on that loan, now the lender would be able to come back and say, okay, I want to cash in on this policy, and this helps them recoup some of the funds that they would have otherwise lost.
Okay. All right.
That makes sense.
Yeah. Yeah.
That's their way of handling that, mitigating the the potential loss. That's their way of doing that. So a front end ratio, like I was mentioning all of that because I was explaining the PMI, but the front end ratio includes the PMI, your principal and interest, your taxes, your homeowner's insurance, and if you're in like a condo or a place with an association, then your HOA fees are going to be included in that ratio as well. That on FHA can go up to 46.99. Now your back end ratio includes not only what's in your front end ratio, but everything else too. so so now we're talking about what actually is on your credit report. So those items, the revolving debt, your car note, student loans, all those different kind of things. Now that also gets included into your other ratio. So for FHA, you have more room. So you can have a housing ratio that goes up to 46.99, but then you can still have more debt on top of that from your credit report,
Yeah.
and you would still qualify to be able to get the loan.
Yeah. So, in short, in short, I would say the DTI is it mostly, I would say, look at your credit report, right? And pull that information and
Mm-hmm.
then know what your income is. Make sure you calculate it correctly. And then you can get yourself in a position where your DTI won't be a problem. So we've talked all this year about planning, planning.
Planning.
hmm And so you
That's been
have to
like our
plan.
theme for this year, 2022. Planning.
Right. Because next year we've told you the plan all this year. So next year you guys are going to be knocking down our door because you've planned all this year
Yep.
for next year.
To
And
be
so
ready.
right? Yep. So let's get ready. And while you're planning, you look at your debt to income
Right.
ratio and basically what that percentage is. And so then if you see that you're at 70-80%, then you know that you need to get rid of some credit cards.
Yeah, a
Bring
lot.
those right. Bring those balances down. Yeah.
Yeah. And if you're
Right.
ever unsure of what's a good and healthy ratio, or if you want to have it calculated, and you'd rather somebody kind of walk you through it, reach out. That's what I'm here for. Give me a call. That's something we can go over together. Um, so that way you're as close as possible to it. Because you may not get the same number as me, but as long as you're within, a good, how can I say that? Like tolerance, if you will, as long as you're, close enough, then I'm sure we can work things out.
Yeah. Yeah. So Lisa White, House Money Mama, she's always
House
there.
money, mama. I'm still got to come up with I need a jingle.
Right. Oh Lordy. She
Some
needs to
theme
be
music. House money, mama.
help us. Help us. and and I'm Dione Branch from Allure Dream Homes, with a team of agents that's ready to serve you. So let's plan for next year, and if you're ready this year, we're ready for you. So thanks,
Sounds
guys.
good. Good
Thank
night,
you.
everybody.
Good night.